Welcome back to the Deep Dive. Today is Tuesday, December 9th, 2025, and if you're looking at the screens, the overwhelming sentiment is, well, it's just neutral. It's one of those days that kind of suggests you can step away, grab a coffee, not miss a thing. But for institutional traders, neutrality isn't stability. It's more like a blanket covering some real structural stress. So our mission today is to pull back that blanket. We're going to look past the surface calm and analyze the market's deepest plumbing, the microstructure, liquidity, the correlation breakdowns, all the things big money's watching right now for a real directional signal. We need to find the vulnerabilities hiding under this consensus calm. Okay, let's unpack this.
That's exactly right. I mean, if the market is truly neutral, it just means everyone's priced in a very specific story. Usually it's the soft landing narrative. But history shows us that these moments of consensus, they're often the moments of greatest risk. We call it fragile stability. So we're going to focus on the underlying mechanics, the VIX curve, futures flows, cross-asset correlations, to really see where the money is positioned and why this quiet moment demands some critical thinking. We're looking for the cracks.
Let's start right there with the market microstructure, the institutional order book. We're talking about the core E-mini futures, ES, NQ, and RTY. An overnight session, like the one we just had, it should look balanced, right? Price action stuck in a tight range. But even in the quiet hours, you have to read the tea leaves.
You have to. We scrutinize those three because they each have a very distinct personality. And their interactions, or more importantly, their divergences, are often the first sign of an institutional rotation. It tells you where conviction is building, even when the volume is low.
So break them down for us. Let's start with the big one, ES.
ES, the S&P 500 E-mini, that's the boss. It's the anchor. If you see NQ or RTY making a big move, but ES doesn't follow through within, say, a few minutes, you have to treat that move with suspicion. ES has to confirm it.
And NQ, the NASDAQ 100, the tech index.
Ah, that's the fake-out artist. It is so driven by sentiment and high volatility. It's notorious for these big, flashy moves that, well, they just fade.
So if NQ pops 50 points overnight,
you immediately check if ES is coming along for the ride. If it isn't, NQ almost always reverses, and it leaves all those fast money buyers trapped.
High and dry. Okay, what about the RTY, the Russell 2000?
That's the snitch.
The snitch.
Yeah, it's our risk barometer. Small caps are just far more sensitive to the real cost of capital, the health of the domestic economy. So if ES and NQ are having a great day, but RTY is lagging or even flat,
it tells you the risk appetite isn't broad-based.
Exactly. It means the rally is concentrated. And that's a dangerous sign, especially in a supposedly neutral market.
That concentration risk. It leads us right to institutional tactics. Let's talk about trap traders and these liquidity grabs. Can you walk us through the mechanics? How does a liquidity grab actually work?
Sure. So institutions, they need massive depth to fill their orders without moving the market against themselves. The easiest place to find that liquidity, it's the stop-loss orders from retail traders.
Which are all clustered in the same obvious places.
Precisely. Right above the overnight high or right below the overnight low. So an institution will use an algorithm to just spike the price right through that level. They sweep the overnight high,
triggering all those retail stop losses,
which are basically market orders to buy. And that floods the institution with all the liquidity it needs to establish its actual position, which in this case might be a massive short.
So the retail longs stopping out literally fuel the institutional short entry.
That's it, exactly. They get filled on their huge short at the highs, and then the price snaps right back into the prior range, leaving all the breakout buyers, the late retail longs, instantly trapped in a losing trade.
And seeing that high volume spike without any follow-through. That's the key.
It is. It's how you align with institutional flow instead of becoming the liquidity they're hunting.
Given that, and the neutral sentiment we're seeing, what's the implied open look like?
Well, it's likely to be modest, very close to yesterday's cash close. It really reinforces this idea that everyone is just waiting for a real catalyst before making a move.
Okay, so if microstructure tells us institutions are being cautious, that has to show up in the fear gauge. Let's pivot to the volatility complex, to the VIX. Now, for a neutral market, we expect the VIX term structure to be in contango. That's normal. Longer-dated futures are pricier than shorter-dated ones, but here's where it gets really interesting.
Yes. Contango is basically the visual representation of complacency. It says, things are fine now, but maybe volatility rises a bit later. The key insight, though, is the degree of that contango, the steepness of the slope.
And what are the sources showing?
What they're showing is a very steep contango, a persistent upward slope that we've seen since early 2025. This is the yellow flag.
Why is that a flag?
Because a steep curve suggests that while investors are completely underpricing near-term risk, they're betting things stay calm right now. They're anticipating much higher uncertainty later on, specifically into Q1 2026.
So it's a calm before the storm dynamic. The market is buying insurance for next year, but selling it for the next few months.
That's a perfect way to put it. They're betting heavily that the soft landing story holds for the next 90 days, which lets them collect premium by selling those cheap near-term vol contracts.
And if we saw the opposite, backwardation.
Oh, that would be an immediate flashing red light. Backwardation is active fear. It means the market is panicking right now. We are nowhere near that. We are in a state of advanced complacency about the immediate future.
Okay, but even with the VIX itself pretty calm, around 17.5, there's evidence that sophisticated funds are still hedging. How do we square that circle?
We look at the equity options skew. The VIX just measures implied vol around the at-the-money strikes. Skew, on the other hand, measures the demand for out-of-the-money options, specifically puts. And even with VIX at 17.5, investors are paying a persistently high premium for those far out-of-the-money puts. It shows this underlying constant demand for downside protection, the crash hedge.
So smart money is using the cheap near-term VIX.
To fund the purchase of those expensive high-skew puts, they are literally using the market's complacency to pay for their insurance. It confirms that while the headline VIX is calm, the structural demand for protection is incredibly high.
Let's talk about diversification, or maybe the illusion of it. The classic 60-40 playbook is built on the negative correlation between stocks and bonds. If stocks fall, bonds rally. Is that still holding?
The short answer is no. That traditional playbook is broken, or at least it's faltering badly. Our sources confirm a critical breakdown. The 60-day rolling correlation between the S&P 500 and 10-year Treasury futures has turned marginally positive.
Positive.
Yeah, it's sitting around plus 0.10.
Now, plus 0.10 might not sound like a lot, but for a pension fund, for any large portfolio that relies on that negative correlation to manage risk, that is a massive problem.
It's an existential issue for conventional asset allocation. A positive correlation means stocks and long-term bonds are now vulnerable to the exact same macro shock.
Like sticky inflation.
Exactly. If the shock is a higher for longer rate regime, both asset classes go down together. Your portfolio just lost its main shock absorber.
And if that core hedge is failing, let's talk about a strange divergence we've seen. The DXY, the US dollar index, and the 10-year yield. Since April, yields have been climbing, but the dollar has been dropping. Why is that so significant?
Because historically, rising yields should strengthen the dollar. It attracts foreign capital. When the opposite happens, when yields rise and the dollar falls, it's telling a very different story. It suggests the yield rise isn't because of strong U.S. growth. It's because the market is demanding a higher premium to hold long-dated U.S. debt. It could be concerns over fiscal credibility, debt issuance.
So it weakens the dollar's safe haven appeal.
It absolutely does. It's a very nuanced signal that investors are starting to look elsewhere for fundamental safety.
Which brings us to gold and Bitcoin. For a couple of years, they were moving pretty closely together, but that seems to have broken down. Which one is acting as the real safe haven now?
Gold has reasserted its traditional role. It is the crisis hedge, the asset you run to during geopolitical stress. It's decoupled from the speculative risk assets. Bitcoin, on the other hand, has really confirmed its correlation with broader risk assets, especially high beta tech. It tends to move with the NASDAQ.
So the utility is now clear.
Very clear. If you're worried about a genuine market shock, you go to gold. If you think the speculative growth story continues, you treat Bitcoin like a digital growth asset, not an uncorrelated hedge.
Okay, let's step back and look at the macro engine driving all this. We're seeing major central bank divergence right now, aren't we?
We are. The era of coordinated action is over. You have the easing camp, that's the Fed and the Bank of England. The Fed is expected to cut maybe 25 basis points, down to a 3.75% target.
Driven by labor market worries.
Right. And then you have the hawkish camp, led by the ECB. They're holding firm at 2.00% to fight that sticky services inflation in Europe. And you can't forget the Bank of Japan, which is slowly moving toward tightening.
What does that divergence, that gap between the ECB and the Fed, what does that really signify?
It confirms that the age of unlimited free liquidity is over. This is now an era of managed liquidity. The cost of capital is fundamentally higher, and central banks are actively competing. And that puts a lot of pressure on high-flying equity valuations.
Which sets the stage perfectly for the pain trade. The most crowded, the most consensus, and therefore the most vulnerable position in the market. What is it?
It is, without a doubt, long concentrated U.S. large-cap tech.
The AI narrative.
Riding that powerful AI narrative and coupled with a pervasive short volatility bias, everyone is in the same boat, believing that AI growth is inevitable and rate cuts will be smooth.
And that concentration is the vulnerability. So what are the two main triggers that could cause this whole thing to unwind violently?
The first is AI disappointment. And I don't mean just one company missing earnings by a penny. I mean a real deceleration in hardware sales, or a major miss from a linchpin, like Microsoft or NVDA, that suggests monetizing AI is much harder than the market thinks.
That shatters the narrative.
It shatters it. The second trigger is simply higher for longer rates. If inflation proves stickier and the Fed has to delay cuts, or even hint at reversing course, you have to remember these tech valuations are long-duration growth.
A higher discount rate just crushes them.
It crushes them immediately and dramatically. An unwind of that trade would be fast and indiscriminate.
Okay, so let's synthesize this. The thesis is fragile stability. The calm is deceptive. If we believe that, what's the tactical trade for an institution right now?
The high conviction play is to go long volatility. You do it through VIX futures, spreads, and strategic tail hedges. If the market is underpricing future risk, you buy that risk now while it's cheap.
So how do you structure that specifically?
We'd use a VIX futures calendar spread. You buy the 6-month VIX futures and you sell the 3-month VIX futures. You are actively betting on that term structure getting steeper. You're profiting from today's complacency and tomorrow's fear.
And what about the tail hedges? The out-of-the-money puts that give you that big payout if the market really cracks.
Yeah.
How do you structure that to manage the cost?
You can use a strategy like the 1x2 put spread. It's a powerful hedging tool. You'd buy one out-of-the-money put, say at the 5,000 strike on the S&P, and then you sell 2 puts at an even lower strike, maybe 4,800. Doing this significantly reduces your upfront cost because the premium you get from selling those 2 lower puts helps pay for the higher one. It lets you keep that deep downside protection while offsetting the cost of owning options in a calm market. We'd be looking at March or April 2026 expirations.
And this whole strategy depends on watching a few key levels. What are the 3 numbers you have on your screen that would change this entire narrative?
For the S&P 500, a sustained move above 5,350. That would be a signal to start reducing the hedges. It would suggest real fundamental strength is taking over.
And the downside trigger, the level that confirms the crack.
A decisive break below 5,000 on the S&P, that's a huge psychological and technical level.
Yeah.
If it breaks, it confirms a full-blown risk-off event is starting. And finally, we're watching the 10-year Treasury yield. A clean break above 4.50% confirms that higher for longer narrative is real. And that would be a massive tailwind for our entire long volatility thesis.
So what does this all mean? The market's neutral headline, it really relies on this consensus view of a soft landing, of immaculate disinflation. But our deep dive shows a structure that's, well, it's fragile. You have positive equity bond correlation, a steep VIX curve, heavy concentration in tech. The whole thing is sitting on a tightrope.
It is, and the real challenge for you, the listener, lies in that consensus. The biggest risk isn't some sudden crash. It's persistent inflation, especially if future U.S. policy thinks tariffs, big tax cuts, pushes the Fed to run it hot. That would just crush expectations for multiple rate cuts in 2026. It could force a major policy error. So we challenge you to think about this. How would your portfolio fare if those long-duration growth stocks, the heart of the AI story, were suddenly hit by sharply rising discount rates? That's the silent killer, and it's what we need to be watching for.